By the end of this video, you will know the 8 common trading mistakes day traders make that cause them to fail at trading. And we are starting right now. Hello, I'm Alexander Soares from avistrader.com, and in this video I want to talk about the 8 common trading mistakes traders often make. The desire to make money is at the heart of what causes traders to fail. Let me know down in the comments below if you are currently struggling in your trading so we can look at it together, and let me help you so you can take part of the club of successful day traders. Make sure to stick around until the end of the video and don't forget to click the like button and subscribe to the channel. Now let's take a look at the 8 common trading mistakes traders often make. Beginning with point 1. Point 1 of today, little preparation or training. Little prep or training. Underestimating what it takes to be a profitable and successful trader is a common mistake. Trading is hugely rewarding, but it is also quietly demanding. The best traders out there are the ones who committed to whatever it takes to become a success. That means studying charts or learning new trading methods, or to prep as much as possible for what the market may throw their way. Let's move on to the second point of today. Too emotional. Many traders get so emotional involved in their trades that if the trade goes against them and they are wrong, they react badly and fail to keep their emotions in control. It may sound easier said than done, but try to remain objective at all times. It will make you more intelligent when you're making trading decisions, and it will also help you avoid making emotional trades. Stick to your trading strategy and execute it. Let's move on to the third point, lack of record keeping. Lack of record keeping. It is strongly recommended to keep a trading diary. For example, every time you enter a trade, print out the chart and write down why you entered the trade, whether it was fundamental, technical or a tip. Keep a diary will help you analyze each trade, and even if you're losing money, little by little, you will notice you'll be learning from your mistakes, which in time will help you become a better trader. Money management and record keeping are just as important as technical analysis. Let's move on to the fourth point, expecting easy profit. Easy profit. A lot of traders enter the markets assuming they will be successful, while others, particularly new traders, put together unrealistic calculations of how much profit they will have to make. Anticipating how much you'll make on advance can be very dangerous. Instead, it would be wise to enter the market with a neutral attitude. Let's move on to the fifth point, blindly following mechanical systems. Most traders use online trading platforms like NinjaTrader that provide charting, research and backtesting tools to help them refine their strategies. Now that's fine, but don't rely too heavily on these tools without a full understanding of their capabilities. Technologies such as charting software or other analysis tools is meant to assist you, They are the tools of the trader and they do not think for you. 6 points. The sixth point for today. Placing stop orders too tight. Tight stops. Placing stop orders is the easiest way to help protect yourself against taking a big loss, but placing them too tight can be just as disastrous. This is something many novice day traders incorrectly do by placing stop orders too tight, which usually causes their position to get stopped out too early and having to look for a re-entry, or even missing the move and fail to capture profit. Want to know more about stop losses? Please watch the previous video, The Truths About Stop Losses That Nobody Tells You. You can find a link in the description. 7 point. Risk-reward ratios. Risk vs. Many traders do not calculate risk-reward ratios of a trade before they establish a position. Now, a risk-reward ratio is a relationship between an investor or trader's desire for capital preservation at one end of the scale and the desire to maximize returns at the other end. But determining that ratio is something that traders tend to find through their own experience and is therefore according to their own comfort level. Before you enter a trade, the first question you should ask yourself is, what is the risk-reward ratio of trading this particular asset? If you're new to trading, stick to a low risk-reward ratio, as this will help minimize potential losses. And the last point of today, let profits run and cut your losses. Let your profit run and cut your losses. When you make a mistake, you need to know when to call time and continue on to the next trade, rather than holding out and hoping that the market will turn and eventually losing a lot of money on the trade. This also works the other way. Letting profits run is fine, but it's very important to establish how far to let them run and take that profit and get out, or vice versa, not letting a trade run and taking profits too early. If we have an average daily range, for example, of 100 ticks, and going for a profit of 200 ticks is just daydreaming. Greed is one of the biggest mistakes traders often make. I hope you have enjoyed this video. Again, leave any comments, questions below. Also click the like button and subscribe to the channel. If you are watching this on my website at avistrader.com, please click the share button. Tip for today. Do you want to know more about trading strategies? Then go to my website at avistrader.com and get your free copy of the ebook, The Benefits of a Rule-Based Trading System. Thanks for watching and see you next time.